Hi, now we're going to continue with our last video for Chapter 2, and these are the financial statements. To save time, I wrote some of the titles into the financial statements. You may have to enter them yourself when you're doing the problems in Cengage. They may be blank forms. But anyway, you should know what goes on the financial statements. We're going to be doing them through 6 chapters in the textbook, through Chapter 6. But many students get very confused about the financial statements, but really they're telling you a story of how you did in your business for that month or that year, whatever period of time. So the transactions for the painter, the house painting man that we just completed, we're going to see how he did for that month. So let's say his name is Mike Smith, and he has a painting business. So the income statement, to help you remember what goes on the income statement, think about what the word income means. Income is how much money you make. What's your income? Revenue. Income and revenue mean the same thing. What is your revenue? How much did you make? So the income statement is going to be showing how much he made for that period of time and how much he spent to run his business, which are expenses. So we're looking at only those two categories, revenue and expenses. If you look at your worksheet that we just completed, those were the last two categories on the right. So taking the numbers from that worksheet, if you go back and look at it, his revenue, he earned $2,000 for that month. And so his revenue, I'm calling it painting fees. Now, these columns, you're going to be seeing those in your Cengage or in your textbook. The first column is going to be if he had more than one revenue. We would list them here. But he only has one revenue, one way that he earns money. And so the second column, I'm going to put that he earned $2,000 for the month. He earned $2,000. Now, he only had one expense also. I wish Diane would have had time to have more. If he had more expenses, we would list them each individually here. Total expenses go in the right-hand column. But he only had one expense, rent, $1,000. So since he only had one, I'm putting it in the total column. Now, hopefully, you always want to make more money than you spend in your business, and he did. He made $2,000, and he spent $1,000 to run the business for this month. So I'm going to subtract small number from the large, which is expenses from the revenue. 1,000 from 2,000 means that he had 1,000 left over, $. This 1,000 is his profit, and in accounting we call it a net income. So net means after you subtract something. The 2,000 was his gross income. Gross is a large number. He had an expense, subtracted, what's left is $1,000. So he made a $1,000 profit this month running his business. The next statement is going to be the statement of the owner's equity. Remember, equity was his investment that he made to start his business. And remember that he invested $5,000 to start his business. So in the statement of owner's equity, this first line, capital, for the first month that you start your business, you're going to have 0 there. That's for when did he have a business the previous month? In other words, I'm going to say that he started his business in January. Did he have a business in December? No. So he had no balance carried forward. But he did make an investment in January for his business. So I'm going to add $5,000. Again, this is like the total column. So he invested $5,000 in his business. So his total investment so far for this month is $5,000. So I'm just bringing down that $5,000. The next thing I'm going to say is he made a profit this month. So I'm going up to my income statement and I am bringing this number down. So his net income was $1,000. I'm putting that in the first column. That's how your book wants you to do it. Some books, they add it directly to the 5,000, but we're going to follow how your book, I don't want to confuse you. So $1,000 was his profit. Now, he withdrew some money. Remember at the end of the month, in the transactions, he withdrew $500. So I'm going to say minus $500 that he withdrew for himself. So 500 from 1,000 leaves 500 that he's leaving in his business. So I'm bringing that 500 over to the 5,000. That is his increase in capital. So I'm going to add that 500 that he left in his business to the 5,000 that he began with. And his capital now for the end of January is $5,500. Capital for January the 31st. So again, you're going to have the capital that you're starting the month with. Then you're going to look to see if he made a profit. If he made a profit, that's great. That's going to end up increasing his capital. But then you have to look. He took money out for himself. So out of that 1,000, he kept 500 for himself. He only put 5,000 back in the business. So now he says 5,500. So his capital increased by $500. His investment is growing. The last statement is the balance sheet. So we're going to go back to the transaction worksheet and we're going to go over to the assets now. So his cash, the total of his cash was, I'm going to get it from the worksheet, $2,500. Accounts receivable, the customer still owed him $500, and his equipment was $3,000. So I'm going to add up my assets, and they total $6,000, just like we did in the worksheet. Total of my assets, $6,000. Then I'm going to go to my account payable, and when I look at the worksheet, he owes $500. He still owes $500. Now, capital, and this is the capital for January the 31st we're looking at. So I'm going to take my new capital that I got, and I'm going to bring the new capital over, $5,500. Now, I'm going to add my liabilities to my capital, and this side now equals $6,000. So both sides equal. This is a balance sheet. So we're saying assets equal liabilities plus the owner's equity. We're in balance. But the side is showing that it equals. It's showing that he, even though he doesn't have a very big business, he is doing fine. He only owes $500. His cash, he has $2,500, and a customer is going to give him $5,000. He could easily pay off his debt. So he's doing fine. His business is growing. He left $500 in the business to increase his capital in his business. And he made a profit for the month. So he's doing pretty good for a first month beginning business. So that's the end for Chapter 2. I'll be giving you a video soon for Chapter 3. If you have any questions, please let me know. Thanks. Bye-bye.